Hi guys, I'm Chitra and this is the Poor Kids School of Finance. So here's a question. What is going on? Our economy has crumbled, baby. I mean, my friends are getting laid off and they're like totally smart and charming and shit. Well, no worries. The Poor Kids School of Finance has got you covered. I took one for the team and went out on a luxurious date with some rich guy and he told me what's going on and now I'm gonna tell you. While there are definitely other factors at play, a large part of what has happened to the economy is due to the subprime mortgage crisis. The first thing you have to understand is how banks make money. I go to the bank and put $100 in a savings account that has a 3% interest rate. Then you go to the bank and take out a $100 loan that has a 7% interest rate. The bank gives you the $100 I gave them. At the end of the year, I've made $3, but those sneaky bastards have made $7 off of your loan. The $4 difference they made using my money is pure profit. So now let's fast forward to what's been happening more recently. Now your local bank isn't the only one who's interested in loaning you money for your home mortgage or other debts. Wall Street investors have grown wise to the amount of money that can be made off of the American housing market. So your local bank takes advantage of this and sells your mortgage to a loan packager like Fannie Mae or Freddie Mac. They put your home loan together with other home loans and sell it to a fat cat Wall Street banker, who then takes your mortgage and throws it in an even bigger pool and sells shares of the whole shebang to investors. He's selling shares of your home like it's tickets to a dog fight. These shares are called mortgage-backed securities, and in the last decade, investors couldn't get enough of them. They were seemingly risk-free investments because before borrowers would be granted a home loan, they had to prove that they were financially secure. As far as investors were concerned, mortgage-backed securities were a consistent source of easy money. Some investors recognized an arbitrage opportunity. They took a little bit of their money and used it to get a larger loan at a low interest rate. Then they took that money they were just loaned and immediately invested it in a mortgage-backed security with a higher interest rate yield. The difference in interest rates was pure profit. And this way they had more money to invest and hence more money to profit off of, but they weren't actually spending any of their own money. This is referred to as leverage. So at the end of the day, the money that your local bank gave you for your home loan actually came from a Wall Street investor who got that money on loan too. No one was spending any of their own money, and the debt chain was multiplying exponentially to the point where some Wall Street investors were playing with $30 of chips for every $1 they had invested. It's important to note that mortgage-backed securities themselves are not at fault. In fact, if they hadn't have existed, a lot of Americans that are financially secure enough to own a home wouldn't have been able to find the money they needed for a mortgage. The problem with mortgage-backed securities is that you need a lot of home loans to make them. And sometime around 2003, it just got to the point where nearly everyone who was financially secure enough to own a home already had a mortgage. So now you have investors who are eager to lend out money, but you can't find any suitable borrowers. Mortgages. We need more mortgages. So what did those crafty bankers do? They just changed the qualification requirements. You don't have 20% for a down payment? No worries, just give us 10. You know what, just move in. We'll work it out later. Banks became so eager to find new borrowers that they started dramatically lowering the barriers to entry that had previously made mortgages such secure investments. They started giving out mortgages with liberal terms to borrowers who had limited assets and poor credit histories for little or no down payment. You don't have a job either? Good! Jobs are for losers. Here's your house. These mortgages with lax qualification requirements are commonly referred to as subprime mortgages. Subprime mortgages were usually justified by bundling them together with regular mortgages, hence supposedly mitigating the risk, but still ensuring high interest rates for investors. Since lenders were happy to give them the money, a lot of borrowers bought homes at terms they couldn't afford. And lo and behold, as the terms of their loan began to play out, they were unable to keep making payments on their mortgage. Every time someone defaulted on their home loan, it started a domino effect that worked its way across the debt chain until investors had only one option. Panic! Wall Street was panicking because the bad debts had finally caught up with them. They had borrowed money to invest in mortgage-backed securities, and now they didn't have the money to pay it back. Oh, you wanted that money back?
That shit's gone, dude.
As liquid funds became scarcer, banks found themselves unable to finance their day-to-day operations. As they began to fail, the effects worked their way back down the debt chain towards you and me, until eventually we found the economy in the state it is in now. So there you go, that's what happened to the economy. I know, it blows. But I was trying to think of a funny joke to make you feel better. What I found out, however, is that the American economy being fucked up isn't actually that funny. So instead, I'm going to put on this Ghostbusters t-shirt and tell you everything's going to be all right. Everything is going to be all right. The American economy works in cycles, so eventually things will get better. Until then, just hold tight and don't make any bad financial decisions. Be prepared for the worst and then be pleasantly surprised when things are better than that. Because remember, only the lucky and the prepared are guaranteed financial success. And we can't all be lucky. What should I do with all this money?